Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, Scott, welcome back to another episode of the AWA Market Minute.
Yeah, last one of the summer.
Last one of the summer.
Yeah.
You guys had a good summer?
Yeah, excellent. Always looking forward to fall and football and cooler weather, and we'll take all of that right now.
And this is a particularly, I don't know if exciting or sad or what's the right word for you, but you guys are sending off a son to a mission, a service mission for his church down to Chile tomorrow.
Yeah.
And that'll make two kids out of the house.
Yeah, we'll have two. Yeah, so I have two kids in kind of that young adult phase and next phase of life. And, it's fun to see them moving forward with your life, but it's definitely a, turning of a page and moving on. And so it's kind of with, sadness and nostalgia, but also, excitement as they take the next step.
That time is the awareness of that is happening for our household right now. We've got our oldest is a senior in high school, and so we're starting to realize this is kind of the beginning of those final things.
Yeah.
Right. But it is exciting, and we're definitely preaching to the choir here with all these good people who've lived through this for many, many years. Our clients have got, most of their kids are our age now, so.
Yeah, I feel like older every day when I tell younger people, hey, the time you have with your kids in your home goes by incredibly quick.
Yeah.
And people told me that, and I didn't necessarily believe them, but it's absolutely true.
It is. Well, Scott, I think we've got some great things to cover today. It was interesting kind of preparing for today's meeting. We sent out, our marketing information last week to make sure that everybody kind of knew what was on the agenda. And it's so fun because, as fast as you can get that information out there, the whole landscape can shift on you. And you say, well, never mind. Some of the things that we were really kind of watching for and looking at have already evolved a little bit. And I think maybe a good place for us to dive into why that happens, the way that happens so quickly, is talking about kind of GDP. And what's going on here. So Scott, what exactly are we, what is gross domestic product and what are we looking at and how it measures the economy?
Yeah, so gross domestic product is a measure of overall economic output for the U.S. economy. So when we talk about times of recession, that means economic output has actually gone down. And when we talk about expansion, that means economic growth is occurring. And so we obviously want to see positive GDP numbers. And the sweet spot for an economy like ours, where it's a developed economy, would be 3 to 5%. That would be kind of like ideal, where it's not growing too fast, where we're going to have crazy inflation, but fast enough where we're seeing awesome economic growth. Right now, as far as kind of where those numbers are landing, the real-time estimates for that are about 2.6% is kind of where that's currently tracking. And I think that's indicative of a fairly strong economy, but potentially some chinks in the armor that we should be aware of.
Yeah, and I think this report was saying, 2.3. And so do you feel like that lines up correctly from this report to how kind of you feel about the economy? I think it's a model-driven report, and doesn't take into account some of the subjectivity that, inevitably has impact. Does this report give us a good, accurate depiction?
Yeah, I think it gives us a fairly accurate snapshot in the here and now, but what it's not capturing is developing trends and where things will actually land by quarter end. And so every quarter, this is reported by the U.S. government. And so end of September, we'll know what the actual number is, and shortly after that is when they'll actually report that. But My sense is inflation is ticking higher. The job market does seem to be slowing somewhat. And so that might be a slightly overly rosy number relative to what we're actually seeing.
Yeah. Well, and it's interesting because I think it's a great report to understand the data and kind of get a good snapshot. It's not always a perfect science. In Q1 of 2022, this same reporting group put out a forecasting model that showed GDP would actually be higher. They were forecasting significant growth, and by the end of the year, it came in quite a bit negative. And so some of those gaps can exist. Let's talk about how steady growth, corporate spending tells its own story. And so some of the big firms have these capital expenditures. Scott, this next slide kind of walks through what those different cap expenditures look like.
Yeah, so we've seen a ton of spending in the AI space. The artificial intelligence space has just been a bonanza right now. There's a gold rush, a modern day gold rush in that space, and people are spending everything they can in that space. And so this chart we're looking at right here, Paul, shows capital expenditures, meaning the funds that are put forward for projects by big companies. And this narrows in on 4 specific tech companies: Meta, which is Facebook, Google, Microsoft, and Amazon. And the vast majority of this money is going on to AI directly.
Yeah.
Hardware, data centers, software spend, talent, all that stuff. They are spending enormous sums of money to the tune of $100 billion every quarter. And that's helped bolster GDP. Some of that positive GDP number that we're seeing is being driven by this.
Yeah. So do you see it as a bullish sign for innovation? Or is it more of a red flag if spending outpaces returns?
Yeah, I can't help but think of the .com bubble, at the turn of the millennium, where companies were buying into the internet lock, stock, and barrel, and telecom companies in particular were hot stocks as well as internet stocks. And there was definitely an overinvestment in the infrastructure. And so a lot of those companies ended up doing poorly from a performance perspective, not because the internet wasn't revolutionary, not because the concepts weren't great, but because they overspent on the capital expenditure side. And there's a potential concern that that's happening right now.
Well, I think it's interesting because it's kind of hard to know what AI will become, right? I mean, from where we stand today, like if we went back in time to the early 2000s and Steve Jobs said, we're going to build a smartphone. I don't know that any of us at that time had the foresight to be able to understand how that smartphone was going to revolutionize the way we operated our daily lives 25 years later.
Yeah.
Right. How it impacted and changed and influenced the way we interacted with each other. I mean, how it paved the way for things like social media and I mean, a whole new way of communicating with each other and understanding each other. And for better or for worse, I'm just saying it just revolutionized things. And sometimes I look at AI in a similar fashion. The .com cap expenditures were all around like, cables and servers, and today it's data centers and AI chips, and I wonder, we look backwards, and hindsight's always 20/20 armchair quarterback, right? But it's how much of what they invested in then actually was relevant today, and how much of what we're investing in today will be relevant in 20 years. That's where things get tricky.
Yeah. And investors will often invest as though the current hot company will always be the hot company. And the hot companies of the early 2000s aren't necessarily the hot companies of today, although some still are, but a lot of those have, kind of fallen by the wayside.
Yeah, I mean, reportedly Microsoft is spending over $10 billion a year on just the infrastructure alone. I mean, it's a staggering sum of money. And I guess where this, we have to just kind of think about this from the investor's perspective. You've got a couple, interesting anecdotes here. A recent MIT study really shook sentiment when they reported that 95% of companies investing in generative AI saw no financial returns. And then even OpenAI CEO has kind of publicly cautioned that investors' expectations might be inflated, according to Financial Times. And so I think it's just worth noting that there's a tremendous opportunity here, but we probably ought to be measured in how we approach that.
Yeah, this is the kind of two things can be true at once. AI will likely revolutionize how we do things, and AI companies or those heavily invested may not always be optimized investments.
Yes. And I think that ties in quite well with, this Magnificent Seven, because most of those guys are kind of driving this AI space. Nobody's dominated the market more than these, so-called Magnificent Seven. So this next slide, Scott, walk us through what we're looking at here.
Yeah, so if you'll indulge me for a second, Paul, every time I hear that term, I get a grin on my face. So I'm a huge fan of the Western genre of movies. I grew up watching John Wayne movies, and there was a movie in the 1960s called The Magnificent Seven. Yul Brynner was the star of that, and then they did a remake of that show recently with Denzel Washington and Chris Pratt, and it's one of my favorites, so I can't help but think of going there. But the Magnificent Seven doesn't refer to a Western movie here.
It could.
Yeah,
and
could.
Maybe we got a couple of clients who that's what we've been thinking. They've been thinking of that the entire time you mentioned Mag 7. They think, I don't know how that ties into that old Western.
Yeah.
So you probably just did somebody a huge service.
There you go. So the Magnificent Seven in this context are going to be the top 7 technology stocks. These are household names like Microsoft, Amazon, Google, those types of names. And they have been on a spectacular tear over the past 5 years.
247% return. That's pretty phenomenal.
Yeah. And what's been really amazing with this is, there's definitely been some frothy speculation there, but there's also been just gobs of earnings that have supported a lot of that growth. And so the $100,000 question right now is, can those rates of return and can that growth continue? Mathematically speaking, it's going to be a pretty tough task.
Yeah. So, is this risky for retirees to chase these names today? Is it a good concentration? I mean, when you look at like the S&P 500 and that portfolio, because it is weighted by the capitalization of each business, ends up being so concentrated in the Mag 7. So if we're in any kind of index that tracks the S&P, unintentionally we become very heavily concentrated in those same positions. Is that a healthy concentration, or are we kind of setting ourselves up for a wake-up call?
I think probably more of the latter. We like owning these, but we just like owning them in the right proportions. So we still feel optimistic about the space. We feel like there's growth in the space, but we want to own these in measured amounts. And we'll see indices that will be comprised, 35 to 50% in the Magnificent Seven. Specifically, we'll see client portfolios who have an outside 401k, and they'll have an S&P 500 fund and a technology fund and a growth fund. And when you do the analytics on those, they might have half of their portfolio in 7 stocks. And when things are going great, that's a wonderful space to be. But if we have a material pullback, boy, there's a lot of concentration and exposure there.
Yeah, just to further illustrate that point, back in 2023, NVIDIA, their market cap would grow in a single day by more than the total value of the S&P's smallest 300 companies. So if you own NVIDIA at the right time, that feels kind of incredible, but the problem is mean reversion is an inevitable fact in math and statistics. And so the concern is if we've got too much of our portfolio in one concentration, for a retiree, that is a pretty significant exposure.
Yeah, and I think about NVIDIA specifically, and this isn't commentary on, hey, is it a good buy or not, but just something I think to food for thought. They're worth about $4.4 trillion right now as far as their market capitalization. The U.S. annual GDP is about $29 trillion. So we're saying a single company is worth about 1/6 of the annual U.S. economy. That's tough, right? Yeah. That's that you have to make some big assumptions to get there to justify that.
Yeah. Well, stocks are one story, but for most households, housing is the bigger line item. So let's check on kind of home prices.
Yeah, so we've seen a pretty significant rise in home prices as well. So over the past 5 years, home prices are up about 50% over that period of time. So if a home was worth $500,000 5 years ago, it's worth $750,000 today, and that has priced a lot of folks out of the housing market, particularly younger people who are trying to get into homes.
So the question here, Scott, is home prices are, up double digits. So how does that affect retirees who are attempting to downsize or maybe even tapping into their home equity?
Yeah, it kind of hits them on multiple fronts. I think the most common thing that we see is a smaller home, if it's a newer build, often is as much or more than the home they're looking to sell. A lot of times there's an idea of, hey, I don't want to maintain this yard. I don't need this big house. Let's find something that's more suitable for our needs. And a lot of times that's a push as far as the cost, and sometimes it's even a little bit more.
I've seen that, and it's actually really interesting where people will say, I can always rely on my home. This is too much home for me. So if retirement gets a little too tight, and we do the models and the math comes back and they say, gosh, when I'm in my early 80s, maybe what I'll do is I'll sell my home. I've got this 5,000 square foot home and I'll be able to cash out a big chunk of equity and I'll be just fine. And I think there's a little bit of danger in relying too heavy on that as an exit strategy, because it is not uncommon for me to see clients who are in that space today who say, I'm going to sell my home and downsize, and they come back with virtually no equity. Yeah. So that's kind of a scary thought. The other thing that I hear a lot, Scott, talk to me about, people will say, this feels reminiscent of 2008.
Yeah, and I get that sentiment. We in '08 we saw a rapid rise in home prices. We've seen a rapid price increase recently. I think the difference, though, is kind of the structural drivers of this. So in '08 there was a speculative bubble where there was a glut of supply of homes and a lot of loose lending standards, cheap and easy money, and a lot of those things led to that housing bubble. This feels more like a supply problem where there's not enough supply to meet demand, and so those prices have been pushed up. And then the other thing that's exacerbated that is up until recently, rates had been so low that also created a bubble where that pushed prices up even higher. And so I think this one's different in kind because it's more of a supply problem versus the speculative problem that we saw in '08.
Yeah, no, I like that. I think it was, two different structural issues, right? The prices collapsed under too much supply in 2008. And today prices are relatively sticky because supply is kind of tight.
Yeah.
And so it's a very different, I would say totally different situation that we're up against. And, people tend to anchor to these historical points, especially when they were traumatic historic points. And that doesn't mean we're going to repeat the same, outcomes over and again. What's the phrase you like to use? History doesn't always repeat itself, but it does tend to rhyme.
Yeah, you do see that, right? Housing, you see some maybe rhyming there between the dot-com bubble and today's AI boom. You maybe see some similarities there, but I think it's important to dive into those and look at the nuanced differences, because if we too blindly look at a simple relationship between those two, we can miss the boat a little bit.
I think that probably speaks to the need to having a good objective advisory team around you, because I think sometimes we think we've lived one experience, therefore we can just kind of learn from that and then copy and paste throughout retirement, and that's not really true, because every situation is so unique and the composition of the problems that we face are so unique that we really need to have a more nuanced approach to how we deal with every problem that we're up against, rather than just saying, oh, I saw the 2008 housing crisis, now's a good time to sell. And that's not always the case.
Yeah.
So Speaking of rates, you talked about that. Let's take a look at what markets are predicting from the Fed. What exactly is the Fed Watch tool?
Yeah, so what this is, the Federal Reserve sets kind of baseline interest rates for the economy, and a lot of interest rates are driven off of this. Not 100%, but a lot of them are driven off of this. And so they'll set rate expectations. And so all things being equal, lower rates are going to tend to expand the economy, tend to push up asset prices, and can be potentially inflationary. Higher rates kind of do the opposite. They tend to lower inflation, they tend to slow down the economy, so kind of opposite effects. And so this chart right here shows that based on financial futures contracts, so people betting with their pocketbooks, where are rates going to go? And so the Federal Reserve meets regularly throughout the year. The next meeting is on September 17th. And right now, the Fed funds rate, or the interest rate they're setting, is between 4.25 and 4.5. There's about an 85% chance, according to futures markets, that will go down by a quarter point. And so most market analysts feel like it's almost a lock that we see a rate cut in September. And then similarly, either in October or December, we'll likely see a second rate cut. And so we'll likely see interest rates at the Fed funds level go down by 0.5% between now and year end.
Okay, so, and I know we've explained this chart a number of times, but I think it's really helpful to kind of wrap our minds around this. This is where one of the best predictors of sporting outcomes aren't the analysts who know the players. It's Vegas, where people make bets.
Yeah.
And this is the equivalent.
Yep.
Of that. This isn't necessarily an analyst who's saying, watching the economy, this is my best guess. This is people saying, let's put our money out there with what we think will happen. And right now it's leaning towards some significant rate cuts. So let's talk about this application. Someone sitting in cash today, how should they think about timing CDs, treasuries, bonds with that kind of outlook?
Yeah, so I think in the near term, there is a likelihood that the rates generally go down. Longer term, that's probably a different discussion. But in the near term, we'll likely see some rates going down. So for savers, this is probably a good time to lock in higher rates. If there's opportunities with CDs, with things like annuity contracts and other things to lock in higher rates, this isn't a bad time to be doing that. Flip side, if you're looking to borrow money to buy a car or buy a home or whatever, we might see some relief on the financing side in a short amount of time. So, for savers, it's going to be strike while the iron's hot. For borrowers, it's probably bide your time a little bit because things will likely get a little better.
Interesting. Okay. And I think it's, on the saving and investing side, for retirees, every quarter point movement could mean hundreds of dollars difference on a six-figure ladder. So, if you're in retirement there and you're trying to stretch, what you're able to do for spending purposes and cash flow purposes, that is significant. That is a significant opportunity. One thing I will say is it's hard to use this data to rely too heavily on it. I mean, we need to use it. It's there, it's available, but it's not always a perfect science. In July of 23, markets were betting 90% that they would have a cut by year end. And as we both remember, the Fed did not move an inch that year.
Yeah. And I think, and it's a great point, and I think right now, too, this is such a political football right now where the administration is pining for lower rates and trying to muscle the Federal Reserve to lower rates. The Federal Reserve is, pushing back. But the most recent indications from Jerome Powell is that the softening in the job market is making them concerned, and markets responded favorably to that because that likely, was an indication that rates will go down. But the Federal Reserve is under pressure. Whether they, kind of capitulate to that or kind of, stick to their anti-inflation kind of mandate, it'll be interesting to see.
Yeah, absolutely. Well, that naturally takes us to the backbone of all interest rates, which is the 10-year Treasury, Scott. So walk us through this chart here.
Yeah, so the 10-year Treasury is a borrowing rate for 10-year U.S. government bonds, and it's one of the most helpful indicators for the general level of interest rates. And it's driven by the federal funds rate, yes, but also by the fiscal profile of the United States. And so it's a really good general interest rate indicator. And a lot of people feel like, hey, interest rates are elevated today. By historic standards, that's not the case. If we look at where interest rates are at today, they're in the low fours as far as where the 10-year rate is at today. If we go back to the early 2000s, it was closer to 5%. If we go back to the 90s, it was closer to 6%. And then we go back into the 80s, and it went through the stratosphere as inflation was trying to be driven down.
In 81, the 10-year peaked at 16.
Yeah, pretty remarkable. And so by historic standards, we actually have pretty low rates. It's not going to feel that way because we hit all-time historic lows in 2020. Not hyperbole, you have to go back to Egyptian times to get lower rates than what we had in 2020. And so those were historic lows, and in my opinion, it's unlikely that we'll see those again. And so the new normal is probably going to be elevated, and 5% is not a high 10-year Treasury rate by historic standards, and we're not there yet. We're still in the low fours as far as where we're at.
Yeah, so that's an interesting point then, Scott. So how will that shape a retiree's portfolio, that they rely on that steady income?
Yeah, so I think, again, there's kind of two things at play. So in the near term, we could see some interest rate relief based on a more accommodative Federal Reserve and potentially a slowing job market. Longer term, because of the depreciation of the U.S. dollar, the desire of other countries to replace the U.S. dollar as the world's reserve currency, our fiscal problems with the huge amount of debt, those things will tend to push rates higher. Yeah. And so in all likelihood, for savers, there will likely be, in the longer term, higher rates that you can have for bonds, for savings vehicles, et cetera. So short term, probably a little bit of a break with interest rates. Longer term, there's some significant structural hurdles to not have higher interest rates in the future.
Yeah, I mean, and one of those is we talked about the housing, problems and affordability of housing in 2023 when we had that rate spike. Housing affordability hit a 40-year low. We talked about, opening today's conversation up with our kids, and they're all kind of getting into that age where they're moving into young adulthood and will be working on adulting over the next decade. And that's a scary prospect to think, okay, how are these kids going to be able to afford a home when prices have moved as high up as they have, and we are, kind of giving them a double whammy with the potential for interest rates saying the new normal is 5%. When we were going into the housing market 20 years ago, we were saying, hey, 2 and 3 is the new normal. So that is a double-edged sword for some of these younger kids.
Yeah, and I think affordable housing will be a political topic near the top of the list for the foreseeable future. In the New York City mayoral race, that's been a hot item that's been a point of discussion. And I think on it with our national politics and local politics, I think housing affordability will be a near the top discussion in coming years.
Yeah, it'll be interesting. I mean, just pontificating here, I often wonder if this will actually shape. We talk about like the revolution of like the smartphone to how it impacts our lives. I often wonder if our children will look at what their dream housing situation looks like very differently than what we grew up thinking. We saw our parents with the big house, and I think that maybe we thought, okay, we need that to be successful, and we wanted to build that, maybe even a bigger version of that. And I wonder if the next generation is going to say, I want no maintenance, I want a small maintainable piece of property. I want to be able to spend my time doing other things than cutting my grass and plowing my snow. Yeah. So. And certainly that wouldn't be a bad thing from an affordability perspective if that is the new psychology of where they want to live. Scott, let's transition and talk about, markets are one thing, but, obviously confidence and spending behavior are another. So we talk about consumer sentiment. Tell us what this next slide is representing.
Yeah, so this is a survey published by the University of Michigan, super well respected, and it's a consumer sentiment survey. So, how are you feeling about things? Are you inclined to make big purchases? Just an overall taking the pulse of how consumers feel about things. And consumer sentiment, as you can see here, this version of the chart is going back to 2015, and you can see that we're at or near lows as far as that goes. And if we stretch the tape measure back further, we're near all-time lows for as long as they've had this consumer sentiment index. And so right now, this is indicative that people are a little bit hesitant to hang out their shingle and start a new business, or to make a big capital expenditure, or to, stretch to get that new home. And so there's a lot of reluctance on the, side of the consumer based on how they're feeling about things.
So is this a trend that is telling us something by way of the economy's in bad shape, or is this just indicative of a bunch of more and more grumpiness that we are living with in today's retirees?
I think it's a little bit of the latter, but what I think it is an indication that we're probably punching below our weight as an economy. And what I mean by that is, if we're in the mid twos right now as far as our GDP growth, if we had happier dispositions as far as the economic outlook, we could be more like 4%, because there's these positive feedback loops that happen when people get excited about things. They go and buy that home, and that leads to demand for construction, and they start that new business, and they give people jobs. And so all of those things drive economic growth. So even with this sour disposition, the economy's still doing pretty well.
Yeah.
It begs the question, what could the economy do if people felt more optimistic about things?
Yeah, that's a powerful way to look at it. I mean, reading Malcolm Gladwell's book right now on outliers, and he talks about this a lot, right? The concept that so much of what we experience is actually kind of our perspective and perception of the reality that we live in. We will shape that with that kind of attitudinal approach. And so, yeah, I look at this chart on consumer sentiment and I think, okay, is this indicative of an actual problem that we're up against, or is it more indicative of the general overall psychology of where we're at? I mean, I can't tell you the number of times we had conversations where people are just sour on the economy as a whole, but yet we keep slugging along in the economy. So to your point, that is an interesting, take that maybe this economy could even be a hair stronger if we had a different perspective on how we looked at it. In 2011, sentiment was near recession levels, this chart sentiment, but the S&P finished the year double digits up.
Yeah.
So it's kind of a good reminder that feelings about the economy don't always match market reality.
Right.
And that kind of spills into the country's whole direction, Scott. So take us through this next slide.
Yeah, so this next slide is just a simple survey and a very reputable one as far as, hey, how do you feel about the direction of the country? Are we moving in the right direction, or are we moving in the wrong direction? And then what this chart shows, it goes back a couple decades, but what it shows is that over time, the country generally has had a pretty pessimistic outlook as far as, directionally where things are going. You can look in the, 2010s where we were below 20% as far as are we going in the right direction. As it stands today, that figure is about 40%, which still means 60% of the country, with statistical margin built in there, give or take, still feels that we're heading in the wrong direction. But by recent standards over the past couple decades, that actually is a relatively high spot relative to where it's been. It's still indicative that a majority feels negative rather than positive, but relative to the last 20 years, it's a pretty high spot to be. And so for the midterm elections, that will have implications there. The midterm elections will be heavily influenced by that sentiment and also what the economy is doing at that point in time. Although I will say, over the past 3 to 4 administrations, there's been a big trend to do a lot of work via executive order rather than legislation.
Yeah, right.
And so the composition of Congress isn't probably going to be as impactful as it has been in the past, because I think we'll see a lot of things continue to be done via executive order. And so I think while this has political ramifications, certainly its impact on the market might not be as significant as what some might think.
Yeah, I think that's a good way to frame that, Scott. I think, this is, from my take, this is probably more noise than it is something I base my investing decisions around. Always we look at the fundamentals when we make our investment decisions, and less some of this stuff I think is just, like we said, noise. But I do think, to your point, it will likely have a more material impact on the overall election process and kind of the feeling around who we're willing to put in positions of power based on this overall mood of which direction the country's going. Well, Scott, I think that's all we've got time to cover today. That was good. That was great stuff. Yeah. So we appreciate the opportunity to kind of go over this together, and hopefully it's helpful. There's a lot to unpack here. We often jokingly talk about having to triangulate the truth, so to speak. There's just all these different news sources out there that today it's hard to even qualify as news, because it's more of like attention grabbing headlines, sensationalizing everything with the goal of driving clicks and profits. And so what we try to do for our clients in these 30-minute meetings is to try to take that information from all the different sources and find the different data points, and somewhere in the middle we'll likely come up with an objective version of what's helpful.
Yeah, we try to do a lot of distilling, right?
Yeah.
We gather as much as we can and then try and distill, where we feel like the facts lie and the impactful things for the investment. But it's a lot. There's a lot of noise out there, and we try and, get to the underlying data that we think is relevant to these discussions.
Yeah. Well, it's great to be with you guys all again. And until next month, take care.
Thanks.